Liquidity in trading. On Wall Street, there is an unwritten rule that every professional trader knows by heart. You cannot make money if there is no liquidity. The price may move in your predicted direction, your technical setup may be flawless, and the fundamental news may support your thesis. But if you cannot enter or exit your position at a fair price, the entire trading plan becomes meaningless. This is why liquidity is often described as the lifeblood of the financial markets. Think of a financial market as a bustling highway filled with thousands of vehicles moving every minute. Liquidity is the flow of traffic on that road. When the road is crowded and traffic moves smoothly, every vehicle can travel quickly without causing major disruptions. But when the road becomes empty and illiquid, a single truck changing lanes can create significant turbulence. Markets behave the same way. In a highly liquid environment, large orders can be absorbed without much price movement. In an illiquid market, even small orders can trigger sharp price swings. Throughout financial history, the most devastating market crashes have been closely tied to the disappearance of liquidity. From the crash of 1987 to the dot-com bubble in 2000 to the global financial crisis of 2008, one common thread is that critical moment when everyone wanted to sell but no one was willing to buy. In such moments, prices do not fall simply because of bad news. They collapse because the market runs out of liquidity. That is when fear overwhelms logic, and those who react too late become victims of a free-falling market. For individual traders, understanding liquidity is just as important as analyzing trends or managing risk. Liquidity directly affects transaction costs through the bid-ask spread and slippage, the ability to enter and exit positions, especially during volatile periods. Trading psychology, since illiquid markets often lead to erratic price behavior and emotional stress. Liquidity is also not static. It changes across trading sessions, instruments, and timeframes. A currency pair may be extremely active during the London Open and then become quiet during the Asian session. A blue-chip stock listed on the New York Stock Exchange may trade tens of millions of shares per day, while a penny stock may sit idle for hours without a single trade. Skilled traders know how to select the right battlefield with the right level of liquidity that matches their strategy. In this chapter, we will explore the true nature of liquidity, how it is formed, how it is measured, and most importantly, how to use the flow of liquidity to improve your trading performance. On Wall Street, success does not belong only to those who predict the direction of price, but also to those who understand where the money is flowing and when to move with it. Definition of liquidity in financial markets. Liquidity, when discussed in the context of financial markets, is far more than a simple measure of how easily an asset can be bought or sold. It represents the very capacity of a market to function as an efficient mechanism for price discovery, capital allocation, and risk transfer. On Wall Street, liquidity is often described as the oxygen of trading, invisible yet absolutely vital. Without it, markets suffocate, prices distort, and participants are left exposed to risks they cannot easily hedge or exit. At its core, liquidity refers to the degree to which an asset can be converted into cash or into another asset at a predictable price and within a reasonable time frame. A liquid market is one where there are always willing buyers and sellers, and where the gap between what someone is willing to pay and what someone else is willing to accept remains narrow. Conversely, an illiquid market is characterized by wide gaps, erratic price jumps, and difficulty in executing trades without moving the market against oneself. Different perspectives on liquidity. Defining liquidity becomes more nuanced when examined from the standpoint of various market participants. For the retail trader, liquidity means being able to enter and exit a position at will without suffering large losses from slippage or unfavorable fills. To this trader, liquidity is a shield against being trapped in a position. For institutional investors, liquidity is a much larger challenge. When a hedge fund or pension manager wants to allocate hundreds of millions of dollars into a stock or currency, the concept of liquidity extends beyond execution ease. It involves considerations of market depth, potential market impact, and the ability to unwind positions over weeks or months without attracting attention. For regulators and exchanges, liquidity serves as a measure of market health. A liquid market is viewed as transparent, resilient, and efficient, while an illiquid one is seen as vulnerable to manipulation, disorderly conduct, and systemic instability. Thus, liquidity cannot be reduced to a single dimension. It is simultaneously about speed, cost, volume, stability, and the willingness of participants to engage at prices close to consensus value. The components of liquidity. Liquidity is best understood as a multidimensional concept made up of several interrelated components. 1. Tightness. This refers to the cost of transacting, often represented by the bid-ask spread. A tight spread signals that buyers and sellers are closely aligned in their valuation of an asset. Markets with tightness allow traders to transact with minimal friction. 2. Depth market depth describes the volume of orders resting at different price levels in the order book. A deep market can absorb large transactions without significant price movement. For example, a blue chip stock with thousands of buy and sell orders layered across price levels is considered deep, while a thinly traded penny stock is shallow. 3. Resiliency. A liquid market is not only deep, but also resilient. After absorbing a large order, prices tend to return quickly to equilibrium levels as new participants step in. In illiquid markets, by contrast, a large order may cause prices to spiral out of balance for extended periods. 4. Immediacy. Liquidity also implies the ability to transact immediately when needed. A market might have depth, but if orders take time to execute or are only available in limited windows, it lacks immediacy. High-frequency markets, such as foreign exchange majors, provide immediacy almost around the clock. Each of these dimensions interacts to create the overall liquidity profile of a market. A truly liquid market exhibits tightness, depth, resiliency, and immediacy simultaneously. Liquidity as a dynamic property. One critical point is that liquidity is never constant. It fluctuates in response to economic conditions, investor sentiment, market structure, and even time of day. A trader may find ample liquidity during the opening hours of the New York Stock Exchange, but far less in the final minutes of an illiquid after-hours session. Similarly, liquidity in the Treasury market may dry up during periods of political uncertainty, even though Treasuries are normally regarded as the most liquid securities in the world. Historical crises illustrate how quickly liquidity can vanish. During the flash crash of May 6, 2010, the sudden withdrawal of liquidity providers caused the Dow Jones Industrial Average to plunge nearly 1,000 points within minutes before rebounding. This event highlighted that liquidity is not guaranteed. It depends on the continuous presence of buyers and sellers willing to engage. The relationship between liquidity and volatility. Another defining feature of liquidity is its complex relationship with volatility. Generally, high liquidity tends to suppress extreme volatility as abundant buy and sell orders cushion price movements. Yet, in stressed markets, the sudden evaporation of liquidity can amplify volatility dramatically. Prices may gap violently, not because of a shift in fundamental value, but because the market lacks participants willing to take the other side of trades. Professional traders watch liquidity indicators closely for this very reason. A widening of spreads, a thinning of order books, or unusual delays in execution are often early warnings of rising volatility. In practice, liquidity and volatility form a feedback loop. Reduced liquidity heightens volatility, which in turn discourages participation, further draining liquidity. The role of liquidity across asset classes. Liquidity manifests differently depending on the asset class. Equities. Liquidity varies widely from mega-cap stocks like Apple or Microsoft, which trade tens of millions of shares daily, to small-cap names that may not trade at all for hours. Market makers and exchanges play a crucial role in maintaining liquidity for the broader equity market. Foreign exchange. The Forex market is often described as the most liquid in the world, with trillions of dollars transacted daily. However, liquidity is uneven across currency pairs. The euro-dollar pair is extraordinarily liquid, while exotic pairs can be thin and volatile. Fixed income. Paradoxically, even though the U.S. Treasury market is vast, it can experience sudden bouts of illiquidity, especially in times of stress. Corporate bonds are notoriously less liquid than equities, as they are primarily traded over the counter rather than on centralized exchanges. Commodities and derivatives. Futures contracts on major commodities are liquid, but contracts on less common instruments may be illiquid. Options markets vary significantly in liquidity depending on strike prices and expiration dates. Recognizing these differences is essential for traders and investors, as liquidity risk can vary dramatically across markets. Liquidity as confidence. Liquidity is ultimately built on confidence. Traders provide liquidity because they believe they can quickly offset positions, hedge risk, and operate in a stable environment. When confidence breaks down, liquidity vanishes. This was evident during the 2008 crisis, when even markets for traditionally safe assets froze because participants lost trust in counterparties. The realization that cash is king was simply another way of acknowledging that liquidity itself had become the scarcest asset. For the individual trader, liquidity means freedom, the freedom to act, to adjust, to cut losses, and to take profits when opportunities arise. For institutions, liquidity is the foundation that allows capital to flow and strategies to be executed. For markets as a whole, liquidity is the glue that holds together the system of price discovery and resource allocation. Conclusion. Defining liquidity in financial markets goes far beyond saying that an asset can be bought or sold quickly. It is a multidimensional, dynamic, and fragile characteristic of markets that influences every aspect of trading and investing. It encompasses tightness, depth, resiliency, and immediacy. It shifts across time, assets, and circumstances. It shapes volatility, reflects confidence, and underpins stability. On Wall Street, liquidity is not just a background condition. It is the silent force that determines whether markets operate smoothly or break down in chaos. Understanding its definition in practical terms is the first step for any trader who wishes to survive and thrive in the unpredictable world of financial markets. The origins of liquidity. Liquidity, in its purest form, is the natural result of human interaction in markets. It is born whenever two parties agree to exchange an asset at a specific price and quantity. Without this meeting of interests between buyers and sellers, markets would remain theoretical constructs with no real function. The origin of liquidity lies in the constant tension between supply and demand, and the willingness of participants to trade under conditions of uncertainty. From the earliest marketplaces in history, where merchants gathered to exchange spices, metals, or agricultural products, liquidity was already at work. A busy market with many merchants and buyers offered smoother transactions, more accurate prices, and lower bargaining costs. In contrast, a deserted marketplace with only a few participants was prone to erratic price changes and difficulties in completing trades. This fundamental reality has not changed. It has merely evolved with the sophistication of modern financial markets. In contemporary markets, liquidity emerges from three primary sources. 1. Natural investors and hedgers. These are participants who buy or sell assets for investment purposes or to manage risk. A pension fund buying blue-chip stocks or a farmer selling futures contracts to lock in crop prices both add to market liquidity. Their trades are motivated by economic needs rather than short-term speculation, and their presence provides a base layer of steady transactions. 2. Speculators and traders. Liquidity also comes from those who participate with the goal of profiting from price changes. Day traders, proprietary trading firms, and hedge funds contribute by constantly taking the other side of trades. Though often criticized for being short-term in nature, speculators are vital because they ensure that buyers can find sellers and sellers can find buyers at almost any moment. 3. Market makers and intermediaries. The most direct source of liquidity in modern finance is the group of institutions whose role is to continuously quote both buy and sell prices. Market makers stand ready to absorb order flow, narrowing the bid-ask spread and reducing transaction costs. On Wall Street, these players include large banks, broker-dealers, and increasingly high-frequency trading firms that use technology to maintain a continuous two-way market. Liquidity is also influenced by infrastructure. Exchanges, electronic communication networks, ECNs, clearing systems, and settlement processes create the framework where liquidity can thrive. Without transparent order books, reliable clearing, and enforceable contracts, even the most active participants would hesitate to engage, leading to thin and unstable markets. At its origin, liquidity is never guaranteed. It must be created, nurtured, and sustained by trust. Trust that the counterparty will honor the trade, that the exchange will clear the transaction, and that the regulatory system will protect the integrity of the market. The moment trust erodes, whether during a banking panic, a corporate scandal, or a systemic crisis, liquidity evaporates. This fragility underscores the importance of confidence in maintaining market functioning. In essence, the origin of liquidity is not a mysterious financial construct. It is the collective willingness of human beings and institutions to interact, to bear risk, and to exchange value. Whether on the floor of the New York Stock Exchange, across electronic networks, or in decentralized digital markets, liquidity arises from the convergence of needs, expectations, and trust. It is this convergence that transforms markets from static price boards into living, breathing ecosystems. Measuring liquidity. The critical factors. Liquidity is not a static quality. It is a multidimensional phenomenon that requires careful measurement. Traders, portfolio managers, and policymakers cannot rely on intuition alone. Instead, they must evaluate specific indicators that reveal how easily an asset can be bought or sold without creating excessive price dislocation. Wall Street has refined a set of tools and variables to capture liquidity, recognizing that no single measure can fully describe it. What follows is a systematic exploration of the primary factors that define and measure liquidity in modern financial markets. NARA 1. Bid-ask spread. The most fundamental measure of liquidity is the bid-ask spread, the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask. Narrow spreads indicate deep liquidity. Buyers and sellers are close in their price expectations, and transactions can occur efficiently. Wide spreads signal thin liquidity. Either there are fewer participants, or they require more compensation for the risk of being wrong about the asset's value. For example, a large cap stock such as Apple may trade with a spread of just a few cents, reflecting massive liquidity. By contrast, a small cap biotech stock might have a spread of several dollars, demonstrating limited market depth. The spread also reflects transaction cost. Every trader crossing the spread incurs a cost, which compounds over time for active strategies. On Wall Street, traders scrutinize spreads across venues and instruments to identify where liquidity is cheapest. 2. Market depth. While the bid-ask spread measures surface liquidity, market depth captures what lies beneath. Depth refers to the number of buy and sell orders resting at various price levels beyond the best bid and best ask. A deep market features thick layers of orders at multiple levels, providing cushion against large trades. A shallow market may show a narrow spread but collapse if a large order removes most of the standing liquidity. Depth is typically visualized in an order book or through a depth of market DOM display. Professional traders monitor depth to anticipate whether their orders will move the market. High-frequency firms often act as depth providers, continuously replenishing liquidity. Yet depth can vanish abruptly during stress events, a phenomenon known as liquidity evaporation. The flash crash of 2010 illustrated how quickly depth can collapse when participants retreat simultaneously. 3. Trading volume. Another proxy for liquidity is trading volume, the total number of shares, contracts, or units exchanged during a given period. High volume usually signals strong liquidity. A large flow of transactions makes it easier to enter or exit positions. Low volume suggests fragile liquidity, where trades may exert disproportionate impact on price. However, volume must be contextualized. A spike in volume might result from panic selling, where liquidity is one-sided. Similarly, an asset might display consistent daily volume but still have wide spreads if the volume is concentrated in short bursts. Institutional investors analyze not only raw volume but also volume distribution throughout the day. For example, equity volume tends to cluster around the open and close of the session, while the midday period is quieter. Timing matters when executing large orders. Price impact. Liquidity is ultimately about how much the price moves when you trade. Price impact measures the sensitivity of an asset's price to order flow. Low impact means you can transact large orders without pushing the market. High impact means even modest orders shift prices significantly, a sign of illiquidity. This is especially critical for hedge funds, pension funds, and sovereign wealth funds that must deploy billions in capital. For them, The true cost of trading is not just commissions and spreads, but the hidden slippage caused by market impact. Quantitative analysts estimate impact functions by studying historical order flow and price response. Execution algorithms are designed to minimize visible footprint, slicing orders into smaller pieces to reduce impact. 5. Turnover ratio. The turnover ratio relates trading volume to the total number of shares outstanding for equities or the size of the market for bonds. A high turnover ratio suggests that the market frequently recycles its supply, reflecting active participation and strong liquidity. A low turnover ratio implies that assets are being held tightly, limiting the availability of shares for trading. For example, Treasury securities display extremely high turnover ratios, making them the most liquid fixed income instruments in the world. In contrast, municipal bonds often show very low turnover, explaining why individual investors face wider spreads when trading them. Hanner 6. Time to execution. Liquidity is also a function of speed. The time it takes to execute a trade, particularly at the desired price, reveals the true ease of transaction. In highly liquid assets, execution is nearly instantaneous, even for large orders. In illiquid assets, orders may sit unfilled for hours or days, or may only be completed by accepting adverse price adjustments. Electronic markets have dramatically reduced average execution times, but disparities remain across asset classes. Equities and futures are near instant. Corporate bonds and private placements can still take significant time to trade, reflecting structural illiquidity. 7. Volatility and liquidity interaction. Liquidity and volatility share a two-way relationship. Elevated volatility can signal liquidity stress, as wide price swings often occur when order books are thin. Conversely, ample liquidity tends to dampen volatility by absorbing shocks. Measuring liquidity thus requires tracking realized volatility, implied volatility, and intraday price fluctuations. During crises, spreads widen, depth vanishes, and volatility surges, a classic liquidity spiral. Traders use volatility-adjusted measures of liquidity to distinguish between structural illiquidity and temporary market stress. 8. Amihud illiquidity ratio. Beyond surface measures, academic finance has developed sophisticated liquidity metrics. The Amihud illiquidity ratio, widely used in research and portfolio management, captures the average price impact per unit of trading volume. Formally, it is calculated as, open quote, Amihud illiquidity equals average return volume. Close quote. A high value implies that small volumes generate large price changes, hence low liquidity. A low value implies that even significant trades have minimal effect, indicating strong liquidity. While not commonly cited on trading floors, this measure provides institutional investors with a robust way to compare liquidity across different securities and markets. 9. Roll's spread estimate. Richard Roll's model offers an indirect method of estimating bid-ask spreads by analyzing serial correlation in price changes. It assumes that negative autocorrelation in returns reflects the bounce between bid and ask prices. Though more technical, this measure allows analysts to infer spreads even when order book data is unavailable, making it useful for historical studies or illiquid markets. 10. Cross-market and cross-asset liquidity. Liquidity cannot be assessed in isolation. Increasingly, professionals examine liquidity linkages across markets. For instance, futures liquidity often leads spot liquidity. ETF liquidity depends on both its own order book and the liquidity of its underlying basket. Currency liquidity fluctuates across sessions, with London and New York providing the deepest pools. Measuring liquidity requires acknowledging these interdependencies. A dislocation in one market can instantly ripple into others, as seen when Treasury futures liquidity drives movements in the broader bond market. 11. Institutional versus retail liquidity. Finally, liquidity must be differentiated by who it serves. What looks liquid to a retail investor trading 100 shares may be illiquid to a pension fund moving 10 million shares. Institutional-grade liquidity is measured not only by spreads and depth, but also by block trade availability. The ability to move size without signaling intentions is the ultimate benchmark for professional liquidity. This is why Wall Street often relies on dark pools, block trading desks, and algorithmic execution to access hidden liquidity that is invisible in public markets. Conclusion. Measuring liquidity is as much an art as it is a science. No single indicator suffices. Professionals must integrate multiple signals: spreads, depth, volume, impact, volatility, turnover, and execution speed to gain a holistic picture. Moreover, liquidity is dynamic. It shifts across time, venues, and participants, often evaporating precisely when it is most needed. For traders, liquidity measurement is not a theoretical exercise. It is a survival skill. Every decision to enter or exit a position carries liquidity risk, the possibility that the market will not be there when required. By mastering the metrics of liquidity, one acquires not just a set of analytical tools, but a deeper understanding of how markets breathe, flex, and sometimes fracture. Liquidity and trading strategies. Liquidity is not just a background condition of markets. It is an active force that shapes the way traders design, execute, and refine their strategies. A trader's awareness of liquidity can be the dividing line between consistency and collapse, between capturing opportunities and falling prey to slippage and hidden costs. On Wall Street, liquidity is never treated as a passive feature. It is a battlefield condition that must be studied, anticipated, and integrated into every aspect of a trading plan. Liquidity as a strategic variable. Every trading strategy implicitly or explicitly makes assumptions about liquidity. A scalper depends on the ability to enter and exit positions within seconds with minimal slippage. A swing trader assumes that positions can be scaled without distorting the market. A long-term institutional investor expects that accumulated orders over weeks or months will be absorbed without triggering panic. Liquidity determines not only the feasibility of these strategies, but also their profitability. Ignoring liquidity is equivalent to ignoring volatility or risk. It blinds a trader to the true nature of the playing field. Liquidity and trade execution. Execution is the most immediate arena where liquidity interacts with strategy. Even the most robust technical setup or fundamental thesis can unravel if entry and exit cannot be executed efficiently. Execution costs take the form of spreads, slippage, and market impact. Spreads define the first cost of liquidity. A narrow spread signals abundant liquidity, making market orders less expensive. Wide spreads, common in illiquid markets, mean the trader is effectively paying a tax just to participate. Slippage occurs when the actual execution price diverges from the intended price due to insufficient depth in the order book. For strategies reliant on precise entry levels, slippage can erode edge quickly. Market impact is a more insidious form of cost. Large orders move the market against the trader. Institutional strategies are especially vulnerable here, and sophisticated execution algorithms are designed to minimize impact by slicing orders and disguising intent. A trading system that neglects these execution realities is structurally incomplete. Liquidity conditions transform theoretical profits into real-world outcomes. Liquidity across asset classes. Liquidity characteristics differ across asset classes, and strategies must adapt accordingly. Equities. Large-cap stocks typically provide ample liquidity with tight spreads, suitable for both retail scalpers and institutional investors. Small-cap stocks, however, can show thin order books, leading to violent price swings. Futures and options. Futures on major indices or commodities generally trade with deep liquidity. Options, on the other hand, often suffer from wide spreads and limited depth, forcing traders to adjust sizing and timing carefully. Forex, the foreign exchange market, is the most liquid in the world, but liquidity is fragmented across banks and electronic platforms. Major pairs like EUR/USD trade with almost continuous liquidity, whereas exotic pairs can behave like illiquid equities. Cryptocurrencies. Digital assets reveal liquidity's fragility most vividly. Even top tokens may face sudden liquidity droughts during stress events, making stop-loss execution unreliable. Traders must size smaller and accept higher risk of gaps. Understanding the liquidity profile of the chosen asset is not optional. It is foundational to the design of realistic strategies. Timing and liquidity cycles. Liquidity is not constant. It waxes and wanes across the trading day, the week, and the economic calendar. Strategies tuned to these cycles enjoy structural advantages. Intraday cycles. In equities, liquidity is highest near the open and close of the trading session, when institutional flows dominate. Midday often sees thinner activity, which can trap intraday traders in stagnant conditions. Weekly cycles. Liquidity tends to peak around key events such as economic data releases or central bank meetings and fade during holiday weeks. Crisis cycles. In times of systemic stress, liquidity can vanish altogether, creating liquidity gaps. Strategies designed without stress testing under illiquid conditions are prone to catastrophic breakdowns. Smart traders embed these cycles into their playbook, choosing to act aggressively in high liquidity periods and defensively in low liquidity ones. Liquidity and risk management. Liquidity is inseparable from risk management. Stops and limits, the trader's primary tools of risk control, are only as reliable as market liquidity allows. A protective stop in a liquid market behaves as expected. In an illiquid market, the same stop may be skipped entirely due to gaps, leading to uncontrolled losses. Furthermore, liquidity risk compounds during leverage. A leveraged position in a liquid asset may be tolerable, but in an illiquid market, forced liquidation by margin calls can trigger devastating spirals. Institutions therefore impose liquidity filters on tradable instruments, refusing to deploy capital into assets that cannot be liquidated quickly under stress. Retail traders often underestimate this dimension. They assume liquidity will be available when needed, not realizing that liquidity is most scarce when it is most essential. Embedding liquidity-aware rules into a risk management framework is therefore critical for survival. Liquidity and strategy styles. Different trading styles carry distinct liquidity dependencies. Scalping strategies require ultra-high liquidity and minimal spreads. Scalpers thrive in major currency pairs, index futures, and mega-cap equities, but struggle in illiquid instruments. Day trading strategies balance liquidity needs with volatility. Liquidity ensures efficient entries, but traders also depend on temporary liquidity vacuums to fuel rapid price swings. Swing trading strategies require enough liquidity to enter and exit moderate-sized positions without disruption, but they can tolerate temporary illiquidity better than scalpers. Position trading and investing focuses on long-term horizons. While short-term liquidity may be less relevant, the ability to liquidate large positions during rebalancing remains critical. Algorithmic strategies embed liquidity metrics into execution logic, dynamically adjusting order size and aggressiveness based on real-time order book conditions. No strategy is immune to liquidity considerations. The difference lies in the time horizon and tolerance for execution costs. Liquidity and market microstructure. A sophisticated understanding of liquidity requires studying market microstructure, the mechanics of how orders are matched and trades are confirmed. Order book dynamics reveal the true battlefield of liquidity. Visible liquidity. The displayed bids and offers represent only a fraction of real supply and demand. Hidden orders, iceberg orders, and dark pools complicate the picture. Liquidity fragmentation. In modern markets, liquidity is spread across multiple venues. A trader who sees only one venue's order book may misjudge total depth. Latency and speed. High-frequency firms compete to provide liquidity at millisecond scales, influencing how spreads and micro-movements behave. Strategies designed without accounting for microstructure risk being arbitraged by more sophisticated participants. Liquidity premium as opportunity. Illiquidity is not always a disadvantage. It can be a source of return. Investors often demand a liquidity premium, extra compensation for holding assets that cannot be easily traded. Private equity, distressed debt, and real estate are examples where long-term investors exploit illiquidity in exchange for higher expected returns. Traders can adopt a similar mindset. Illiquid assets may present inefficiencies and mispricings that liquid markets quickly arbitrage away. The challenge lies in balancing opportunity with the heightened execution and risk costs of trading illiquid instruments. Building liquidity into a trading plan. Integrating liquidity into a strategy requires deliberate steps. 1. Liquidity screening. Select assets with adequate average daily volume and tight spreads for the intended style. 2. Sizing rules. Match trade size to order book depth, avoiding positions that could materially move the market. 3. Execution protocols. Use limit orders, algorithmic slicing, or dark pool routing where appropriate. 4. Contingency planning. Prepare for liquidity shocks with wider stops, reduced leverage, or position trimming. 5. Review and adaptation. Regularly evaluate whether chosen instruments maintain their liquidity profile, especially in evolving markets. Liquidity should be treated as a first-order design variable, not an afterthought. Conclusion. Liquidity is not an abstract financial concept. It is the lifeblood that determines whether strategies thrive or fail. Traders who ignore liquidity trade in a theoretical world, detached from the harsh realities of execution and market structure. On Wall Street, liquidity is studied as meticulously as price action or macroeconomic conditions because it is the invisible force that turns plans into profits. Successful strategies recognize liquidity's cyclical nature, its variability across assets, its central role in execution, and its integration with risk management. Whether a scalper hunting for micro moves or a long-term investor allocating capital across asset classes, liquidity awareness is indispensable. In the end, liquidity is strategy. The best traders do not just navigate liquidity, they harness it, anticipate its shifts, and design systems that thrive within its ebb and flow. Liquidity and crowd psychology. Liquidity in financial markets is not merely a mechanical attribute of order books or market depth. It is also deeply intertwined with human behavior, perception, and the collective psychology of participants. While metrics such as bid-ask spreads, trading volumes, and order book depth provide quantifiable measures, the true essence of liquidity often fluctuates according to shifts in market sentiment and crowd dynamics. Understanding how collective psychology shapes liquidity allows traders to anticipate when markets will remain fluid and when they may dry up, exposing participants to outsized risks. The emotional foundations of liquidity. At its core, liquidity is a function of willingness, the willingness of buyers and sellers to transact. That willingness is never purely rational. It is filtered through emotion. Fear, greed, confidence, and uncertainty drive the decision to step into or withdraw from the market. When optimism dominates, participants are eager to buy, sellers are confident that bids will be filled, and liquidity flows freely. In periods of fear, however, participants hesitate, spreads widen, and liquidity becomes fragile. These psychological currents can turn a market from highly liquid to virtually frozen in moments, often without warning. Herd behavior and liquidity concentration. One of the most powerful forces affecting liquidity is herd behavior. Crowds rarely distribute themselves evenly across markets or asset classes. Instead, they cluster around narratives, momentum, or perceived safety. When a crowd rushes into a particular stock, currency pair, or sector, liquidity initially appears abundant. Volumes surge, order books fill, and execution becomes easy. Yet beneath the surface, this liquidity is concentrated rather than diversified. It exists as long as the herd continues to support the trade. Once sentiment shifts, that same concentration can lead to a sudden vacuum. Orders disappear, spreads explode, and liquidity evaporates. This paradox highlights how crowd psychology can create both the illusion of deep liquidity and the reality of fragility. Panic selling and liquidity spirals. Few phenomena demonstrate the psychological roots of liquidity more clearly than panic selling. When fear spreads through the market, rational valuation often collapses. Traders rush to exit positions, yet few are willing to take the opposite side. What follows is a liquidity spiral. Sellers outnumber buyers, order books thin, and prices gap violently. Liquidity spirals are particularly dangerous because they create self-reinforcing loops. Falling prices fuel more fear fuels more selling, and each wave of selling further erodes liquidity. Historical market crashes, from the Great Depression to the global financial crisis, were characterized by liquidity spirals rooted in collective panic. The illusion of liquidity in bull markets. During strong bull markets, crowd psychology often creates the illusion that liquidity is infinite. With confidence high and risk appetite elevated, buyers step in eagerly, and every sell order finds a match. However, this apparent depth is conditional. It is not the result of structural resilience, but rather of collective belief. When optimism falters, the same instruments that were thought to be highly liquid can seize up. Asset-backed securities in the lead-up to the 2008 crisis, or certain high-yield ETFs during credit stress, exemplify how liquidity based on crowd confidence can vanish abruptly. Anchoring overconfidence and liquidity provision. Behavioral biases also influence liquidity provision. Traders anchored to prior price levels may hesitate to provide liquidity at new equilibrium points, leaving gaps in the order book. Overconfident traders may underprice risk, supplying liquidity aggressively until volatility proves them wrong. These biases illustrate how cognitive tendencies translate into real shifts in liquidity across markets. Institutional psychology and market making. Liquidity is not shaped solely by individual investors. Institutional psychology plays a critical role, particularly among market makers, funds, and large asset managers. In periods of calm, institutions willingly provide liquidity, narrowing spreads and absorbing flows. However, when institutional confidence deteriorates, liquidity contracts sharply. For instance, during stress events, market makers may widen spreads, reduce position sizes, or retreat entirely, compounding liquidity challenges. Their behavior is not merely mechanical, but reflects organizational risk tolerance, regulatory constraints, and internal psychology shaped by fear of losses. Feedback loops between liquidity and sentiment. Liquidity and psychology interact in feedback loops. Strong liquidity fosters confidence, which encourages further participation, reinforcing stability. Conversely, thin liquidity heightens anxiety, reduces participation, and leads to even thinner liquidity. These loops help explain why markets can shift from calm to crisis so abruptly. For traders, recognizing these loops is critical. A market with shrinking volumes and widening spreads may not only reflect current sentiment, but also foreshadow accelerating psychological stress. Implications for trading strategy. For traders and investors, understanding the psychological dimension of liquidity offers practical advantages. 1. Anticipating fragility. By monitoring crowd behavior, traders can anticipate when liquidity is overstated. Overcrowded trades, euphoric sentiment, or overly tight spreads may signal fragility rather than strength. 2. Avoiding liquidity traps. During panic phases, entering or exiting trades without regard to liquidity psychology can lead to disastrous fills. Recognizing when crowds are withdrawing can prevent execution in unfavorable conditions. 3. Exploiting asymmetry. Savvy traders can position themselves ahead of shifts in liquidity. For example, when markets are excessively optimistic, disciplined liquidity providers may benefit by supplying depth at inflated levels. While in fearful markets, patient buyers can capture assets at distressed prices. 4. Time frame awareness. Liquidity driven by psychology can be highly time-dependent. A stock may be liquid during peak trading hours when crowds are active, but illiquid during quieter sessions. Traders who align strategies with crowd activity cycles gain a decisive edge. Conclusion. Liquidity as a psychological construct. Liquidity is not a fixed property of markets. It is a reflection of collective human behavior. Just as water levels in a river rise and fall with environmental conditions, liquidity ebbs and flows with the moods, fears, and convictions of market participants. Traders who appreciate this dynamic can move beyond static definitions and integrate psychological insight into their strategies. By recognizing that crowd psychology both creates and destroys liquidity, traders gain the ability to anticipate instability, protect capital, and exploit opportunities hidden beneath the surface of market sentiment. Ultimately, liquidity is as much a psychological construct as it is a financial one, a reminder that markets are not machines but ecosystems driven by human behavior. Liquidity pitfalls. Liquidity, while often perceived as a straightforward market feature, conceals a range of traps that can ensnare both novice and seasoned traders. These pitfalls emerge when assumptions about liquidity diverge from reality, when structural features of markets distort execution, and when behavioral blind spots leave participants vulnerable. In practice, liquidity is rarely as stable, transparent, or reliable as it appears. Recognizing liquidity traps is essential for protecting capital and avoiding the silent risks that erode profitability. The mirage of quoted liquidity. One of the most common traps is mistaking quoted liquidity for executable liquidity. Traders often see large bid or ask sizes in an order book and assume that these represent firm, reliable liquidity. In reality, much of this displayed size is fleeting. High-frequency traders and algorithms frequently post and cancel orders within microseconds, meaning that what appears as liquidity is often an illusion. When volatility spikes, these phantom orders vanish, leaving a trader attempting to execute against levels that no longer exist. The result is slippage, wider spreads, and fills at far less favorable prices. This trap underscores the importance of distinguishing between surface level liquidity and liquidity that can be executed under stress. The trap of size and market impact. Liquidity traps often ensnare traders who underestimate market impact. Entering or exiting a large position may seem simple in theory, particularly in highly traded instruments. Yet markets are not infinite pools of depth. Executing size creates a footprint, pushing prices against the trader's own interest. For example, a fund attempting to liquidate a large equity position may find that each successive sale depresses the price, causing realized exits to occur at levels far below the initial quote. This impact is compounded when other market participants detect the selling pressure and front-run or fade the trade. The assumption that liquidity scales linearly is a trap. In reality, liquidity diminishes rapidly when tested with size. Hidden illiquidity in structured products. Another common trap lies in instruments that appear liquid during normal conditions but become illiquid during stress. Structured products such as mortgage-backed securities, high-yield bonds, or certain exchange-traded funds may trade actively in calm markets, providing the illusion of robust liquidity. Yet when risk sentiment shifts, these products can seize up. During the financial crisis of 2008, many securities that were thought to be highly liquid suddenly had no bids. Even vehicles like bond ETFs, which promised intraday liquidity, became disconnected from their underlying assets. This highlighted a critical trap. Liquidity in derivative or structured products often depends on the functioning of underlying markets, and when those markets freeze, liquidity evaporates across the structure. The trap of overcrowding. Liquidity often attracts crowds, and crowded trades can mask fragility. A currency pair, stock, or commodity may seem highly liquid because of intense participation, but that very crowding creates vulnerability. When too many participants hold the same position, exits become bottlenecked. Consider the yen carry trade, popular in the early 2000s. It seemed to offer unlimited liquidity. Traders borrowed yen at low rates and invested in higher-yielding assets worldwide. When risk sentiment reversed, however, the mass unwinding caused violent currency moves as everyone attempted to exit simultaneously. The trap here lies in assuming that high participation equals sustainable liquidity, when in fact it can sow the seeds of a liquidity crunch. The trap of time horizons. Liquidity is not uniform across time. A trader may assume that because a market is liquid during peak hours, it will remain so at all times. This assumption is dangerous. After-hours trading, overnight sessions, or holiday periods often experience thin participation. Orders that would be absorbed easily during the day can cause outsized moves in these conditions. The trap becomes clear when traders place stops or attempt large trades in illiquid hours. Slippage magnifies, spreads widen, and price action becomes erratic. Successful traders recognize that liquidity has a temporal dimension and avoid the pitfall of assuming it is constant. Liquidity traps in emerging markets. Emerging markets offer another layer of liquidity traps. While they may show active daily turnover, the depth is often shallow compared to developed markets. Political instability, regulatory intervention, or capital flow restrictions can further constrain liquidity. For instance, during currency crises, emerging market central banks may impose capital controls or trading halts, effectively freezing liquidity. Traders who assume that emerging market assets will behave like developed market instruments fall into a dangerous trap, discovering too late that liquidity can vanish overnight, leaving them trapped in positions they cannot exit. Dark pools and the trap of hidden liquidity. The rise of dark pools and alternative trading venues has introduced new liquidity pitfalls. While these venues promise access to hidden liquidity with minimal market impact, they also carry risks. Orders routed to dark pools may not interact with sufficient counterparties, leading to partial fills or delays. Worse, in some cases, participants in these venues may engage in predatory practices, using information gleaned from order flow to trade against participants in lit markets. The trap here is assuming that hidden liquidity equals safer or more efficient execution. Without a deep understanding of venue structure and participant behavior, traders can suffer worse outcomes than if they had executed openly. The trap of liquidity. During volatility spikes. Volatility events reveal the most dangerous liquidity traps. During sharp market moves, whether triggered by economic releases, geopolitical shocks, or unexpected earnings, liquidity can vanish in seconds. Algorithms pull quotes, market makers step aside, and spreads explode. Traders who assume they can execute stop loss orders at intended levels often find themselves filled far worse than expected. This is not merely slippage, but a structural trap of assuming liquidity will persist under stress. The flash crash of 2010, when major equity indices dropped nearly 10% in minutes, is a stark example of how liquidity can disappear when it is most needed. Psychological liquidity traps. Beyond structural issues, traders also fall prey to psychological liquidity traps. A common one is anchoring to historical liquidity. Traders may assume that because an asset was liquid in the past, it will remain so in the future. Markets evolve, participants shift, and instruments fall out of favor, leaving once liquid assets barren. Another trap is overconfidence in execution ability. Traders may believe that their speed, technology, or relationships will guarantee access to liquidity. In reality, when liquidity evaporates, even the most sophisticated participants are constrained. These psychological pitfalls blind traders to the inherent fragility of liquidity. Regulatory liquidity traps. Regulation, while designed to promote stability, can also create liquidity pitfalls. Post-crisis rules requiring banks to hold more capital and reduce proprietary trading have reduced their willingness to provide liquidity. While this has limited systemic risk, it has also made liquidity shallower in certain markets, particularly in fixed income. During stress events, this regulatory backdrop becomes a trap. Traders expecting traditional market makers to step in and absorb flows find themselves without support. The structural changes mean that liquidity is more conditional and fragile than in prior decades. The trap of liquidity premium mispricing. Investors often demand a liquidity premium, higher returns for holding less liquid assets. Yet misjudging this premium is a classic trap. When investors underestimate liquidity risk, they accept yields that do not compensate for the difficulty of exiting positions. This trap is particularly dangerous in private markets, real estate funds, or niche credit instruments where redemption terms are long and secondary markets thin. When redemptions accelerate, funds may suspend withdrawals, leaving investors unable to access capital. The illusion of liquidity, fostered by prior calm periods, becomes a devastating pitfall. Avoiding liquidity traps. To avoid these pitfalls, traders and investors must adopt a disciplined framework. 1. Test liquidity under stress. Do not assume that calm market conditions will persist. Model worst-case scenarios. 2. Account for market impact. Adjust position sizes to minimize self-inflicted slippage. 3. Diversify venues and instruments. Relying on a single venue or asset class increases vulnerability. 4. Respect time variability. Avoid large trades during thin hours. 5. Study market structure. Understand how regulation, technology, and market maker incentives affect liquidity. 6. Prepare for illiquidity. Hold sufficient reserves and avoid overleverage so that forced liquidation is not necessary when liquidity vanishes. Conclusion: liquidity as a double-edged sword. Liquidity, when abundant, fosters confidence, smooth execution, and efficiency. Yet its apparent stability is riddled with traps. Illusions of depth, overcrowded trades, hidden fragility, and time-dependent vulnerabilities. Traders who mistake the appearance of liquidity for its reality expose themselves to severe risks. The key to survival is humility, recognizing that liquidity is conditional, fragile, and often deceptive. By respecting its limits and anticipating its traps, market participants can navigate environments where others stumble. In the end, liquidity is both an enabler and a hazard, a double-edged sword that rewards those who handle it with discipline and punishes those who take it for granted. Practical lessons from Wall Street. When traders first encounter the concept of liquidity, it often seems like an abstract term that only matters to institutional investors or market makers. But on Wall Street, liquidity is a matter of survival. Every tick, every spread, every sudden vacuum of buyers or sellers has the potential to create opportunity or to destroy capital. From decades of collective experience, certain hard-earned lessons have been carved into the DNA of professional trading desks. These lessons reveal not only how liquidity functions in real time, but also how traders must adapt if they wish to thrive in environments where fortunes can be made or lost in seconds. Lesson 1. Liquidity is not static. One of the first realities that Wall Street teaches is that liquidity is not a constant feature of the market. A stock may appear highly liquid during calm trading hours, but in moments of stress, for instance, during earnings announcements, macroeconomic data releases, or geopolitical shocks, that liquidity can evaporate instantly. Traders who assume yesterday's liquidity will be available tomorrow often find themselves trapped in positions they cannot exit without massive slippage. The practical takeaway is that liquidity must be treated as dynamic. Professionals continuously monitor order book depth, volume changes, and spreads, not as static numbers, but as indicators that can shift dramatically. The ability to recognize the early signs of drying liquidity separates professionals from amateurs. Lesson 2. Size matters. Wall Street also teaches that liquidity is relative to trade size. For a retail trader, buying 1,000 shares of a mid-cap stock may seem effortless, but for a hedge fund attempting to acquire 1,000,000 shares, liquidity becomes a real constraint. The market cannot absorb such orders without adjusting price, often significantly. This insight shapes how institutions break down their trades. Algorithms are employed to slice orders into smaller pieces, feeding them gradually into the market to minimize impact. The lesson here for traders of any size is clear. Liquidity must always be evaluated relative to one's intended trade size. A liquid stock for one participant may be illiquid for another. Lesson 3. Hidden liquidity exists. A Wall Street veteran quickly learns that the visible order book is only a partial picture of true liquidity. Dark pools, hidden orders, and algorithmic strategies mean that much liquidity remains invisible. At times, liquidity emerges only when prices reach certain levels, triggered by stop orders or by the activation of large resting orders. This reality demands humility. Traders must avoid overconfidence based on what they see on their screens. They must assume that unseen forces can suddenly shift the balance of supply and demand. This awareness keeps professionals cautious and adaptive, ready to respond when hidden liquidity surfaces. Lesson 4. Liquidity can be weaponized. One of the most sobering lessons from Wall Street is that liquidity is not always a neutral feature of the market. Sophisticated players can manipulate liquidity to create false impressions. For example, large traders may place visible orders they never intend to execute, only to cancel them once they influence price direction. Others may exploit thin liquidity periods to trigger stop losses, forcing weaker hands out of the market. To the inexperienced, these moves appear random or malicious. To the professional, they are recognized as liquidity tactics, part of the competitive battlefield. The lesson is to develop defenses, avoid placing obvious stop orders where predators hunt, learn to identify spoofing or layering, and never assume liquidity is purely organic. Lesson 5. Timing is everything. Liquidity fluctuates not only across days but also within the trading day itself. On Wall Street, the opening and closing hours are known for their bursts of liquidity, as institutional flows concentrate during these windows. Midday sessions, by contrast, often see thinner conditions, leading to more erratic moves. Experienced traders align their strategies with these rhythms. Short-term scalpers thrive during liquid openings, while swing traders may prefer the quieter midday periods for cleaner technical setups. The lesson is that liquidity has a time dimension, and aligning trades with these cycles increases efficiency and reduces unnecessary risk. Lesson 6. Crisis redefines liquidity. Perhaps the most brutal lesson comes during market crises. In moments like the 2008 financial meltdown or the pandemic-driven crash of March 2020, liquidity vanished almost overnight. Bid-ask spreads widened to absurd levels, and assets that were considered safe suddenly became untradeable. Wall Street teaches that in a true crisis, liquidity is a luxury. Survival depends on preparation, maintaining capital reserves, controlling leverage, and avoiding overexposure to assets that depend on fragile liquidity. Traders who internalize this lesson never forget that liquidity is conditional on confidence, and when confidence collapses, liquidity disappears with it. Lesson 7. Liquidity shapes strategy. On Wall Street, trading strategies are often tailored explicitly around liquidity conditions. High-frequency trading firms thrive in liquid markets where spreads are tight and volumes are high. Event-driven funds prefer moments of dislocation when liquidity is thin, creating mispricings. Value investors, by contrast, may exploit periods of low liquidity to accumulate positions at attractive prices, patiently absorbing what others are desperate to sell. This diversity of approaches highlights a critical lesson. Liquidity is not inherently good or bad. Its presence or absence simply defines the type of strategy that is appropriate. Traders who rigidly apply one method across all liquidity environments often fail, while those who adapt strategy to liquidity conditions find enduring success. Lesson 8. Never confuse volume with liquidity. Another nuance that Wall Street underscores is the distinction between volume and liquidity. A stock may trade high volume on a particular day, but if that volume is concentrated in bursts or dominated by one-sided flows, true liquidity may still be poor. Real liquidity requires a balance of buyers and sellers across price levels. The practical lesson is to look beyond surface metrics. Professionals examine market depth, order distribution, and the behavior of spreads rather than relying on raw volume numbers. Misinterpreting volume as liquidity has destroyed countless trading accounts. Lesson 9. Liquidity is global. In today's interconnected financial world, liquidity is influenced by global flows. Wall Street desks constantly monitor overseas markets, currency movements, and bond yields because these factors impact equity and commodity liquidity. A shock in Asia can reduce liquidity in U.S. markets before the opening bell, and shifts in global capital flows can tighten or loosen liquidity across asset classes. This interconnectedness teaches traders that liquidity cannot be viewed in isolation. A comprehensive awareness of global conditions is essential to understanding why liquidity expands or contracts in U.S. markets. Lesson 10. Respect liquidity as a risk factor. Finally, the deepest lesson from Wall Street is that liquidity is not merely a market feature. It is a risk factor in itself. Traditional models often emphasize price risk, credit risk, or interest rate risk, but professional traders know that liquidity risk can be just as deadly. An illiquid market can magnify losses, trap positions, and erode confidence at lightning speed. By treating liquidity as a core risk factor, Wall Street traders integrate it into position sizing, risk limits, and portfolio construction. They ask not only, what is the potential return, but also, can I exit this trade when I need to? This mindset transforms liquidity from an abstract concept into a daily discipline that governs survival and long-term profitability. Conclusion. The practical lessons of liquidity from Wall Street are not theoretical abstractions. They are forged in the heat of trading floors, crisis periods, and competitive battles where only the most adaptable survive. Traders learn that liquidity is dynamic, relative, and sometimes deceptive. They discover that timing, trade size, and global awareness are essential. Most importantly, they internalize that liquidity risk is real and must be respected at all times. For those who embrace these lessons, liquidity becomes less of a trap and more of a tool. It becomes the medium through which disciplined traders can execute strategies efficiently, avoid unnecessary losses, and exploit opportunities when others are paralyzed. On Wall Street, liquidity is not just about getting in and out of trades. It is about understanding the very heartbeat of the market. Liquidity is more than just a technical concept on a chart. It is the invisible force that shapes every trade, every decision, and every market outcome. From its origins in ancient markets to its modern expression through high-frequency algorithms, liquidity has always dictated whether opportunities can be seized or lost. Understanding liquidity means understanding the heartbeat of the market itself. We have explored how liquidity is created, how it can be measured, how it influences strategies, how crowd psychology interacts with it, and the hidden traps that even seasoned traders can fall into. But knowledge alone is not enough. What separates a professional from an amateur is the ability to transform knowledge into disciplined action. On Wall Street, liquidity is not just studied, it is respected. Traders who thrive are those who recognize when liquidity provides safety and when it hides danger. They adapt their strategies, respect risk, and align their mindset with the rhythm of the market. That mindset, sharp, disciplined, and resilient is the foundation of lasting success. If you want to go beyond theory and build a trading practice that endures, you must cultivate not only skill, but also mindset. This is the mission of Trading Mindset Lab, to equip traders like you with the psychological tools, professional discipline, and strategic thinking required to survive and grow in the world's most competitive financial arena. Now is the moment to take your trading journey seriously. Do not let liquidity remain an abstract concept or allow psychology to remain an afterthought. Join a community where traders evolve into professionals, where knowledge is transformed into action, and where mindset becomes your greatest asset. Subscribe to Trading Mindset Lab today and step into the market with clarity, confidence, and control.